Hello guys, I'm Q, the People CFO. Now what I want to talk to you about in the adjusted interest, another type of deferral, is an unearned revenue. In theory, unearned revenues exist when you have a business, and let's say I had a lawn service, and the guy said, you know what, I want you to mow my lawn for the next 6 months. I'm going to pay you the money in advance. I'm going to pay you $3,000, okay? And that $3,000 is going to be for the next 3 months. I'm going to be out of town, that kind of thing. So I'm going to give you cash up front. Okay, immediately, I have done nothing. I have not mowed the grass. One, I haven't cut any grass. I haven't put any acorns up, any leaves. I haven't put anything in the bag. I haven't done anything. So, I haven't earned it. So, because I have not, it's a performance, it's an event that has not taken place. It's an obligation that is due, but I have not done so. Right? So, I cannot recognize revenue yet because it's unearned. That's why we call this entry an unearned revenue. By definition, it's a liability. It's on your balance sheet in the liability section of your balance sheet. So that's the theory, that's the accounting, that's the gap behind it. So now all I can do is just give you a couple examples. So in that example, the guy gave me $3,000 of cash, right, on January 1st. Cash, debit $3,000. Because I haven't done the work, I can't recognize revenue. Unearned revenue, $3,000. Unearned revenue, $3,000. Okay. Now, with that same thing, he leaves, so I'm closing the book for this month of January, right? So I'm going to close the book for January right now. So in about a week, I go ahead and mow the grass. I'm good to go. And then when I mow the grass, I've earned my money. So at the end of January 31st, now I have a revenue I have to represent. That's the whole purpose of GAP. GAP says recognize revenue when earned. I've just earned the revenue. I already got the cash. It's in my pocket, but it's a liability. So I'm going to recognize at least 1 month of the 3 months he gave me. So 3,000 divided by 3 months is 1,000 a month. So I'm going to take my unearned liability, reduce it, because how you reduce unearned liability is by debiting it. Unearned liability, $1,000. I'm going to credit revenue from lawn service, $1,000. So I just reflected the revenue for the month for the money that I just earned, right? So let's take a step back. Before that, in my liability section, I had cash that came in, cash account, $3,000, liability account, unearned revenue at $3,000. If I would close my books at January 31st and not do the deferral entry, which is an adjusted entry we just talked about, my liabilities have been too high, overstated. They're going to ask you that. If you don't perform your adjusting entries for unearned liability or unearned revenue, I guess, is at January 30th, is your liability overstated, understated? My liability is overstated because I should reduce it. Okay? And my revenue on the P&L side doesn't have the revenue reflected. If I didn't book the entry, my revenue will be understated, which means my net income will be understated because I'm going to reflect enough revenue to show some positive flow of money, right? So this adjustment entry, if I book it now, $1,000 to unearned liability, which is a debit, $1,000, and the credit goes to revenue over here, $1,000. At January 31st, my cash is already good. I'm good there. My unearned liability, to balance it out, 1,000 from 3,000 leaves me with 2,000. My unearned liability is 2,000. My revenue now becomes 1,000. Am I in balance? Yes. 3,000. 2 plus 1 $3,000. The book's still balanced. The balance here reflects the true value of revenue, reflects the true value of the unearned revenue. On the liability side, cash is good. We got it at the beginning of the month. Everything's hunky-dory. We're in balance. This is an example of unearned revenue for an adjusted entry when you're closing your books. Now, I can give you a lot more scenarios. You can say, okay, I got a guy, I'm a marketing company, right? My marketing company got an advance of $4,000 to spend ad service over like 3 months or 6 months. I'll divide it over 6 months. Every month I close my books. I would do an entry to do a reduction in unearned liability and a reflection of recognition, I guess the word is, of revenue on my P&L. So that's an example of what I want to talk to you about. Not that rocket science, pretty straightforward. Think about it, just know what your entries are. Understand your T accounts, understand your accounts and what they mean so you can get the reflection and recognition that you need. I'm QPB CFO. That's unearned revenue. I'll get back with you soon. Thanks.